Now let me talk about how do actually the how to actually deal with the marking to market, how to actually settle the contracts in case of the forward, in case of the futures market. Now let me take up a simple example. Say for example, the stock is currently priced at $212. The and the initial margin requirement. Now the initial margin that is required on this is $10, and we have the maintenance margin as $8. Now suppose this Mr. X bought say for example 20 contracts, and he bought up to 20 contracts. Now he is so Mr. X is long on this contract, and we have to discuss how the contracts are actually settled when the prices are given as follows at time 0, 1, 2, 3, 4, 5 and 6. So on day 0 the price is 212, on day 1 price is 211, on day 2 price is 214, on day 3 the price is 209, on day 4 the price is 210, on day 5 the price is 204, and on day 5 the price is 202. Now let me discuss the situation. Let me see how actually when he has to bring up the margin money and how the contracts will be actually settled when the contracts are marked to market. Now let me talk about a simple scenario over here. Let me first do it. Okay. Now we have been given some prices on some days. Say for example, we are given a price at day 0, at 1, 2, 3, 4, 5 and 6. Now let me talk about the beginning balance first. Beginning balance, then let me make some columns, then the amount of funds he has to deposit, then let me talk about the future prices which is given to me, that is 212, then 211, then 214, then 209, then 210, then 204 and sorry, this is 210, this is 210, and then I have 204 and 202. This is these are my future prices that are given to me, and then I have to talk about the amount of change, then we will talk about the gain and loss, and finally we will talk about the ending balance. Now let me talk about this a bit detailed. The person is Mr. X is long. So on day 0 he does not have any beginning balance, but he's going to deposit the initial margin, that is 10 rupees, but he's buying 20 contracts, so he's going to deposit 200, that is 10 into 20, and the price is 212. There is no gain on the contract because the first beginning day, and in his account now we have $200. Now what is going to happen over here? Now see, in over here the price has fallen by $1 as he's long, so he is losing the money. So I will put it here, loss also. So he's losing $1 on one contract. He has bought 20 contracts, which means that he is losing $20, and he in his account now there will be $180. Now the price has risen over here. There is an increase of $3. He has bought 20 contracts, which means and he is gaining $60 now, which will be deposited into its margin account, and he will be having $240 into his account. Now over here the price has fallen sharply and it has resulted in a fall of $5, so he is buying 20 contracts, which means he is having a loss of $100. Now in this case his account would be having only $140. However, the margin call is 8, which means $8 for $20 contracts, so he needs to have $160 minimum into his account. So in this case here I will just mark it here. At this point there will be a margin call, so he will be called to deposit the money. Now how much money will he deposit? He has $140. He has to deposit an amount of, now his balance over here on this day, on the third day, it is now how much it is now $140. That is on the day 4 he has $140 into his account, plus he has to deposit $60. That is, he has to maintain up to the initial margin, get up $200, give deposit up to the $200, and then he can trade further. Now what has happened over here, the contracts have the price has risen by 1, which means he is gaining $20. So which means now into his account he is going to have this 200 plus he is gaining more, so he is going to have $220. The prices are again falling here, the prices are falling by $6, so he is having 20 contracts, which means he is losing on 20 contracts, 6 into 20 contracts, which means he is losing $120. So if we subtract 120 from it, we will be having only $100 over here. Now again $100, he has to bring 100 more up to this margin. So on the next day he is going to have $100 in the price. So let me put up dollars over here. So he's going to bring up $100 more. The price has again fallen, on this day the price has fallen 22, so he will be losing again 40. So now in his account on that day he is going to have 160. So this is how actually the contracts are marked to market when in case of the future contracts. Now let me do one more example. Let me consider a case. Say for example we are given a case that we have a gold future. Now this gold future, a party is long to this transaction. The party being long to this transaction is required to maintain the initial margin of $2,000 and the maintenance margin of $1,500. So now they asked to maintain the $200 and the $1,500 as a maintenance margin. Now the minimum contracts that can be bought is 100 ounces of gold. Now a party has entered into a contract to buy a party has entered to buy a contract at $320 per ounce. Now at what time will there be a margin call? Now what we are required to what they are asking us is that at what price there will be a margin call if the party is long, if the party is long, and what price there will be a margin call. Now see, the difference between the initial margin and the maintenance margin is 500. So the difference over here is just 500. And he has bought these 100 ounces of gold, which means that if we divide this $500 by the 100 ounces of gold, so there will be a $5 rate. Since the party is long and has bought the asset at 320 per ounce, so if the price, so margin call to this party will be only when the price falls, which means if he has bought the asset at $320, if the price is reduced by the $5, which means at $315 there will be a margin call, because the party is long. So in this case the margin call will be at 350 days. What if this, let us take another scenario when the party is short. At what price will he get a margin call? Because the party is short, which means that he will be losing only if the price rises, and the party will be short. Party being short will have to give the margin call only when price is rising by the $5. So for a short party, the margin call will be at 325.